a new solution that every insurance portfolio should have. Totally agree with the name for this webinar. For those who just logged in a bit recently, my name is Jeff Clark. I'm a regional director here with GoldenCare. I've been with GoldenCare for 26 years. I always like to tell a class a little bit about myself. I have basically cut my teeth on long-term care. I eat, breathe, and sleep long-term care for the last 26 years, where we do some med sup here and some other products in life. Really, long-term care is my specialist. So I've spent, again, the last 25 years breaking down, comparing, contrasting long-term care plans, short-term care plans, home health care plans, hybrid life and long-term care things. So I kind of eat, breathe, and sleep this type of stuff. I do enjoy breaking down new products, how they compare to each other, not just traditional long-term care to traditional long-term care, home health care to home health care, short-term care versus, but sometimes hybrid versus long-term care, or short-term care versus long. And that's what we're going to kind of do today. We're going to take this and try to compare how does short-term care fit into our market. So I'm going to go ahead and move forward. I think I bought enough time. So, all right. You remember the good old days of long-term care? 25 years ago. Underwriting was a breeze. Everyone got issued. I know myself, I think most of the clients that I wrote when I was out in the field going door to door back then were 70-year-olds. Occasionally you wrote someone in your 60s, but probably 75% of my clients were people who are 70, 75, because they started to realize that they might need care. Talk to a 50-year-old, they still feel pretty invincible. They're not going to need long-term care. Anyway, the 70-year-olds seem to be where we got a bulk of our business. And of course, the 70-year-olds cause a lot of claims and a lot of things afterwards, but we could get anyone issued. Even if they're diabetic, sleep apnea, joint replacements, all this was no problem. I mean, we even had companies like Penn Treaty that would take them if no one else would. So underwriting was a breeze. Premiums were a half to 1/3 of what current policies cost the same age person, 20 years ago. The prices doubled, if not tripled. Okay. So also there was lots of carriers in the market. Okay, we had, I don't know, 50 plus. There was non-TQ, TQ plans. These are all long-term care plans. So there was all kinds of options, very easy to get underwritten, and premiums were affordable. And in that case, we were able to help out a ton of people. Anyone who kind of breathed the word long-term care, had some curiosity about it, chances are about 80% likelihood we can get them a plan, 90% likelihood. Okay, then things started to change. Then versus now. So 20 years ago, again, there was 50 plus carriers offering traditional long-term care. Well, now we're down to basically 3. The 6 companies you see here, only 3 of them are available in the brokerage arena. The rest of them are captive agents, so they have control those plans. So and frankly speaking, the 3 there are pretty easy to compete with if you have a Mutual, Thrivent, or National. But again, we're down to 3 carriers. All right, and so there isn't a lot of choices anymore. So what's happened because of that? Well, the carriers kind of take what they want, don't they? They kind of cherry pick lately. They don't need to take on any extra risk. They're getting all the long-term care that they want to have. So this market, as it's matured, we started to see a lot of issues that caused many to shy away from long-term care. Kind of a bit of a mass exodus from the marketplace. Carriers have gotten out, agents have gotten out. Trust me, I've managed a lot more agents 15 years ago in long-term care than I do now. We're down to probably, I don't know, I want to say probably a quarter of the long-term care agents that used to be around are still doing long-term care exclusively. Consumers have also gotten out. They've just lost the flavor for long-term care. Why? Well, carriers left because, again, to administer this business, to put this business on the books takes a lot of money and require reserve ratio. It just gets very expensive to administer and have that. There's a prolonged long-term interest rate environment that's super low right now. Long-term care companies are counting on at least 30 years worth of investing premiums to pay those claims. So a low interest rate environment, even a quarter point lower on those low long-range interest rates, can really affect them. And of course, we know how bad it's been. Persistency of over 97%, probably even closer to 98%. Another interesting fact, new generations have a lot more health problems than we did 25 years ago. Just if you look at life expectancy for the first time in, I don't know, 40 years, our life expectancy in this country actually backed up a year, what have you. So whatever you call it, new generational things, habits, bad habits, what have you, there are a lot more health problems than we saw 25 years ago with our senior population. The negative customer feedback, huge in-force rate increases that, if you didn't have long-term care, you talked to your neighbor, he had one, they got rate increases, or they heard it from a bridge club or at church, or they're shying away from it because they hear these things go up. The underwriting, the carriers, they increase a lot of expense to underwrite this business. There's a lot of incompletes. They need to see more. Before they would maybe order APS on some of their clients. Well, now pretty much if you're over age 60, it's likely they're going to be looking at your APS. And then if they do see your records, they need to order an EKG or something else, a specialist you saw. So it's just a very expensive thing to underwrite and administer long-term care. Very expensive. So really, it's become less profitable for the carriers, and the hybrids are really more profitable for them. So you've seen a lot of carriers kind of shift to that direction. So the carriers have gotten out really, and down to 3 of them. Agents, again, declines. Most of the agents tell me, look, it's just too tough to place this stuff, Jeff. You spend so much time. It's a long sales cycle. It's 6 weeks, and you find out you get a decline. The rate increases on existing policies are just, you got angry clients. The newer policies have gotten very expensive. True. The certifications to keep up with, the partnership. There's too many unhappy clients that struggle at claim time. The 90-day certification can be a stickler. I think of my own mom that's had long-term care for 29 years now. And she's waiting to make this claim finally. She's had 2 hips done and 2 knees done, but of course, none of those are long-term care claims. Other surgeries, other things that she struggles with. She feels like she needs to get something out of this plan, but and hybrids, those become more of a popular alternative for the agents and the customers, of course. Now, it's too expensive. It's too high priced. The long-term care hybrids are more, I guess, alluring to people because they're worried about they use it or lose it. It's a constant concern for them. What if I pay all these premiums, I don't get them back? There is a lengthy application process. So all this stuff is kind of culminated where the consumers have just kind of shied away from long-term care. And that's a little bit on the agents, because as the agents kind of shied away, I guess they kind of go to what the market is selling. But I feel like as agents, we need to kind of come back to long-term care and pure long-term care and short-term care. It's still the best solution to solve this kind of stuff, but it's really up to the agents and the industry to kind of put products around that can solve those very problems. So that's kind of the reason why people have gotten out. Carriers, agents, customers. It's interesting that we've had all these carriers getting out, agents getting out, and customers getting out at a time when long-term care has really never been more important. Obviously coming off of COVID, a couple of quick stats here, but 73% of Canadian deaths were people that were in a long-term care facility. Just a couple of those stats here. If you were getting care at home, you only had a 3% chance of contracting coronavirus and a 1% chance of dying. If you were getting your care in a facility, you had a 37% chance of contracting the coronavirus, and 11% of those people died. So frankly speaking, if you're in a facility, you were 11 times more likely to die in a facility than you were getting your care at home. There was already plenty of reasons that people didn't want to go to a facility already. COVID just accelerated that. And we're all still, if you're not aware of that, people are very, very concerned about COVID still. Then on top of this, you had the Washington Cares Fund. I won't go deep into this, but those of you in the industry know what we're talking about here. An actual payroll tax that's forcing people to buy long-term care, state-funded, et cetera, et cetera. This created a humongous demand in the state of Washington. And I'll tell you what, all these states you're seeing here have legislation on the books or are looking at also doing the same thing in Washington state. This is coming, folks, and I feel like it's going to create a tidal wave of people asking about long-term care. All right. So, and we also know the booming population. I don't have to go into this. Everybody knows that we're getting older, we're aging, we're doubling. Our senior population is going to double. There's a tidal wave of care coming. So really, the fact is, there's never really been a stronger demand for long-term and short-term care plans out there. Yet we're in this environment where everyone's leaving, getting out, and leaving the product itself behind. 90% of married couples will require some type of care. And when I talk to my clients, it was never a question of, well, if you need this or if I would just tell them, frankly, when you need care, how are you planning on paying for it? Are you moving in with your adult children, or are your adult children moving in with you? How are you planning on accommodating this when you need care 7 days a week? So I was very direct with them, but just 90% isn't something you should hide from. 90% of adults have never had a real discussion about it. This one we've seen before. 61% of people surveyed say they'd rather die than be in a nursing home. So all this just tells me that there is still a huge demand for the product that we sell. Long-term care is still, it's paramountly important in any good financial plan. You know, you can protect their assets, you can protect their money, you can protect their house, you can protect their car. But if you don't protect them from long-term care, it takes their house, car, and all their money anyways. They lose everything. It's a heck of a fire, and it's hundreds times more likely than to happen than your house burning down. You know, it's 1 in 2, 90%. Okay, so here's this big need, yet we don't have products. So just to give you a little history, you know, GoldenCare was established in '76. Started out, I think, you know, my boss more or less focused on the med sup market, but by late '70s, he already understood the need for long-term care. So we've been involved in the development of numerous long-term care policies going back to the Bankers United days, you know, which eventually became Transamerica. I think GoldenCare did 300-some million of that policy for that product. So we have been involved in designing plans before. So why the shift in focus? Because you just can't ignore the data anymore. Statistics tell us that, you know, the LTCs are surveyed by the American Association for Long-Term Care that half the people between 70 and 75 were declined for long-term care. Over a third of those were between 65 and 69. And we know this. I talked about it. It's why agents have lost their vigor for long-term care. It's hard to get people issued. I get that. It's gotten tough. We're not able to help as many people as we used to be able to help. Okay. And prices become an issue, right? The policies have become expensive. So what can we do about this? This market is shifting. Short-term care insurance is growing rapidly. There's more policies coming out, I can promise you that. I think we're actually in the process of developing another one as we speak. But the introduction of these policies can expand coverage levels and underwriting qualifications. Where long-term care insurance is known for its in-depth underwriting to be able to offer more benefit, short-term care is stepping up and offering coverage where those people can't get it. So in a nutshell, this allows you to help more clients. More clients will qualify and be able to afford the coverage. Huge, right? So I'm a big believer, and believe me, I'm about to go into our new design here. Why short-term care can help save the industry? Because again, long-term care plans had these benefits of 2, 3, 4, 5 years. Inflation greatly increased the exposure and the risk to the carrier. The risk of catastrophic claims, an Alzheimer's claim for an unlimited benefit. You remember we used to have unlimited, right? Or 5 year, 6 year, 7 year benefits that have been compounding at 5% interest. These claims end up being $2 million claims. Much more stringent underwriting was required because of it. Longer apps, bigger delays, the increase in premium, and the complexity of the certifications that were needed. So now let's take it over to short-term care. Now we have a maximum 1 year benefit. It caps that risk for the carrier. A limited benefit period to soften the inflation blow. With a limited benefit period, no real catastrophic claims out there, so they're not afraid to insure people. Underwriting can fill the net much wider. Shorter apps, faster issue, affordable, flexible, much simpler, no special certifications. Short-term care allows us to go back to the future and help protecting our older clients, or all clients for that matter. So, introducing OmniFlex. I'm about to go through just the highlights of this new product we put together, but then I want to go into what I talked about earlier, how I like to kind of get in there and compare and contrast. So you'll notice I'm just going to cover the highlights of this, but having that, we've been marketing this now as a beta, as a test version since about, you know, mid-January. So we're about 6 months into running case tests, actually submitting some applications, but more importantly for me, I've had the agents that have been had access to this have brought me decline cases, have brought me cases they're struggling with, have brought me basically people who were healthy that were buying a small plan, that they were going to maybe look at the other short-term care plans out there, Aetna and GTL. And so I've had some time to get my hands around this. And I got to tell you, it's an eye-opener. It really, with the new things that are in here, it does change the dynamic of short-term care. So I hope you agree. Let me go into this. So introducing, you know, OmniFlex, short-term care. It's welcome to the future of short-term care. I do really believe that. All we really did here is we took some of the benefits that you found in long-term care and made them available in a short-term care plan. So you took the best things that were already in there, and then took some of the things from long-term care and added them in there with it. So a lot of the shortcomings that short-term care have been addressed here. And I think it just turns out to be a heck of a plan. So just a couple of the key points here. Again, we'll be doing more in-depth training on this plan next week. I think and then there's a slide coming up on this, but I think it's Tuesday, June 27th. I believe that's a 11 a.m. training. But so, you know, that's going to be a more in-depth. So for now, let me just hit a couple highlights. So this is a short-term care plan with a full cash indemnity cash benefit. Okay. So I don't know, a nurse comes out in your house and charges you $70, that's all she charges. Well, it's going to indemnify the full amount. If you have $300 a day, it's going to pay the full $300 for every time she comes to your house. So that full cash is a very nice feature. Simplified underwriting. I'm not going to go deep into this how it works, but we talk about throwing the net rider. It's a great benefit. So this thing ramps up to full benefit within a couple of years. 5 starts out at 50. So again, I'm not going to go real deep into that. That's going to be more private. But what this allows is not too many people go unclaimed their first couple of years. And frankly, if you have someone's been declined long-term care or maybe doesn't have much health, they don't think they can qualify, you know, just like with death benefits, if someone's, you know, has some health can be declined everywhere else, the fact that they can get a death benefit that's going to pay them 10 grand, but if they die in the first year, it only pays them 5 grand. The next year and every year after, it pays them, you know, the full amount. That's pretty fair. And for an insurance company, that's kind of, it ramps up the first couple of years. That allows us to do so much more, to ensure so many more things that, you know, if you can kind of fog a mirror, you can get that tier 1 underwriting. So again, I won't go deeper into this. That'll be more for next week, but this simplified underwriting just means that your clients can get this plan, either tier 1 or tier 2. They're going to get one of them. Okay. Fast 50. We all know how important it is to pay family and friends for your care. So this thing allows you to pay anyone for their care. It's 50%. That's why it's called Fast 50. But again, it's a first day cash benefit that lets you to pay anyone. There is no 90-day certification with short-term care, not just OmniFlex, generally speaking. So again, we don't a hip replacement, we're going to get paid. No doctor has to certify this care, in his estimation, is going to go longer than 90 days. I know that any of you have been in this industry. I've written, I don't know, some 600 and some policies now. I get claims about once a month, every 2 months. It's always, well, that care that you're experiencing maybe isn't going to last for more than 90 days. You're probably going to get better. So I have lots of people that call, a lot of struggle there. So I can't tell you how much that no 90-day certification period frees up claims. The optional inflation benefit. Now, this is something, again, until I got in here, and I'd worked with the short-term care plans that are out there, I didn't realize that the short-term care plans, when you put inflation in there, it only inflates the facility, not the home health care. So can you imagine selling long-term care when you added inflation? It only did the facility, not the home care, knowing that 80% of claims start in the home. You wouldn't do that, right? Well, that's kind of how some of the short-term care plans work out there. They only inflate the facility. That would get huge shortcoming. Okay, so that's been addressed. This inflation will inflate both the home health care and the facility side. Premiums are very affordable. That's largely because you get this $300 back in the RX reimbursement. Where do you see this? This is commonly seen in home health care only plans, where you get the $300 back. I think it's explained in another slide here. You know, $10 for your generic and $25 for the name brand. And then restoration benefits, right? It's all but gone in long-term care. You know, I mean, if you sold policies back when I did, you do have some restoration back in the day. So, you know, agents will argue that doesn't get used a whole lot, but it does. You know, there are situations where it does work out. So anyways, those are just some of the highlights. So let's get in here. Simplified underwriting, affordable and flexible. It's not your old style of short-term care plans. I mean, this is a new breed of cat. This is something, again, with the features that are put in there. This is something you shouldn't be putting in that short-term care category. The issue ages, 45 to 89. Two-tiered, I've talked about this, simplified underwriting to ensure coverage is available for a wider range of clients. Spousal discount for 2 people applying, 10%. Restoration of benefits, again, that's just a huge thing. You can restore. Both the facility and the home health care pots can restore, so they can both be used twice. So 1 year, 1 year. In theory, you could get up to a 4-year benefit out of this 1-year benefit. Okay, again, that will come more in the training next week, but it is reusable. Both the facility side and the home health care side can be reused twice. So, and I think I got an example that's going to explain that in a little bit here. So just basic, again, I'm just going to do a quick brushing of the benefits here. So the facility benefit is 50 to 400. So you can get up to 12,000 a month. That's important. I'll come back to that. Elimination period, 0, 26 year, 90, your benefit period. So you can do a 3-month, 6-month, 9-month plan, but let's face it, if I'm writing one of these, I'm always writing a 1-year benefit, right? A lot of these, I guess I could see if someone was 87 years old, I could maybe write a 6-month benefit for them. So there are situations there, but again, I'm mainly always doing a 1-year benefit here. Remember, it's 2 times the restoration. And there's a bed reservation benefit there too. Again, that's another long-term care benefit you see. Decided to go ahead and put it in this one as well. Inexpensive rider, but it kind of sells well. People like that. And remember here, no 90-day certification. Okay. Optional home health care. So this again, we can go 50 to 300. They couldn't go quite as high as the 12,000 a month, so they went up to 300, right? Well, 9,000 a month, right? Also 0, 20, 60, 90. I've been doing enough with this plan now where I'm pretty much putting 0-day home health care. It doesn't change the load that much, maybe 10%, maybe 15% between 90 and 0. To me, that's just worth it. No different than adding the home health care waiver of premium in some of the long-term care plans out there that add about 10 to 15%. Kind of same thing here. Actually, the home health care waiver is a little more expensive. So I do like using the 0. And then again, there's a 1-year plan. There's 3 month, 6 month, 9 month, or 1 year. I pretty much doing the year every time. Okay. So 0-day LM, 1-year benefit. Remember, it's also restored 2 times benefit. So if you kind of think about it, so if you do a full benefit of $400 a day, 12,000 a month times 1 year is 144,000. You know, maybe you had a stroke, maybe you're in a nursing home for a couple of years, a year, a facility, what have you. You get better, you come home, you get Alzheimer's 7 years later, you have access to another 144,000 with that times 2 benefit. Same scenario, maybe you're at home. So you had a stroke, you're getting 9,000 a month, you got it for 12 months, you got paid $108,000, you're fine. 3 years later, you get Alzheimer's. Well, now you get access to another $108,000 in that home. So again, 1-year benefit, don't get hung up on that, especially if I'm paying you twice as much, and then I'll get to this, then the 1 year is something we have to kind of take out of our thinking. All right. Optional simple inflation. This is a little different, okay? So, and this kind of shows the graded benefit I was talking about earlier. So when you buy an OmniFlex benefit, if you do buy, again, I don't know, $200 a day to start, well, the first year, if you go on claim, you get $100 of that. Next year, you get 120, 140, 160, 180. So in the 5th year, you're back to your full benefit. Again, people look at this as maybe a negative. If you're not able to get some coverage on long-term care, then I do think it's fair to say it's like a graded benefit. You know, insurance companies don't want someone to go on claim within the first year, either as an agent. You know, you don't really, it doesn't really benefit you to have someone go on claim within the first 6 months, right? The chargeback for you, it's bad for everyone. So the fact that the insurance company can protect themselves a little bit, because not too many claims do start those first couple of years. If you look at a bulk, a large percentage of those claims out there, you don't see them happen the first couple of years. Okay, so I don't mind that, but with the inflation here, so it's going to be a full benefit in year 5. Well, that's when the inflation starts, 5%. So in 20 years, it doesn't inflate anymore. So this inflation is a lot cheaper than some of the inflation riders that we put on long-term care policies. It basically goes up till it doubles. So if you'll notice this example here, in 25 years, this benefit is now paying $400 a day, or 24. Well, they start at 200. So they're going to pay the full 12,000 a month. Starts out at 6,000 a month. So it's going to go to the point where it doubles and it's going to stop growing. Now, I've done a lot of numbers with this thing, a lot of comparisons. I'm a big believer, generally speaking, on long-term care, that I like putting the inflation up front. I'm not really using 3% inflation anymore, because 5% simple equates very closely to 3% compound if you extrapolate it all over 20 years or 25. But I've been doing a lot of design, shorter, fatter, no inflation. I'm going to talk about that in a second. So I'm not a real big believer in even putting inflation at all in there. So, I when I'm doing this, I go all the way up to $400 to begin with and skip the inflation. It ends up being a better option for, anyone, say 60, 65 or older. So, if I got a 45, 50-year-old, I might do the inflation, but, kind of depending on that. Also, if they're coming off a long-term care premium and they're already prepared to pay $4,000 or $5,000 annually, if I can go ahead and give them a $12,000 a month benefit for 1 year, and with inflation, it still comes in at $3,000 annually, I might do that. So lots of options here. And inflation is just very simply, it's going to double and it's going to stop growing. Okay. Other things, bed reservation. We've seen that in nursing homes, haven't we? In long-term care benefits. So it's going to reserve a bed reservation for you for up to 10 days. Okay. So restoration benefits, again, those don't exist in long-term care plans anymore. They used to, but that's a huge benefit right there. Now, again, some people will say they don't. Yeah, people don't restore. Once they get sick, they get sick, but it does happen. I know it happens because we did a plan called critical care with GTL that there are numerous times where we've had people claim several times, not just twice, 3 times. Maybe they've had a heart attack, later they maybe had a stroke, and then at the end of the day, they end up with Alzheimer's. So it does happen, albeit maybe not that often, but it does happen. So restoration can be very big. Okay, prescription drug benefit. There again, this is something we stole out of the home healthcare arena, that for $10 for every generic and $25 for every brand name. You know, I had a colleague ask me, how often do you think someone's going to get to this $300? And I said, you know, I do a good amount of Medicare work. It seems like, especially in the fall, when people are changing their drug plans. I do a lot of work at the congregation at my church, and these folks will always call me and say, I want to run my meds. There's been a couple of changes, or, you know, and I got to tell you, almost 90% of people that I talk to, the prescription drugs, they're going to have, you know, at least one brand name, 3 or 4, you know, generics. So they're going to have no problem, you know, at $35 a month, one generic, one brand name, they're going to get their 300 back. So I don't know the percentage to give you here. You know, obviously people that don't take prescription drugs aren't calling me to say, let's run my prescription drugs. But when I start people on Medicare, I don't know, there's maybe 10% of people that say, I don't take any. You know, 90% of people have some. So this $300 coming back to you is very attainable. Simple form, you can send it in once a year and get all your money back. So that's $300. That's unique to short-term care. So Fast 50, I talked about this. This is the ability to pay family members and friends 50% of your benefit, first day in cash. You signed up for $400 a day or $12,000 a month benefit. That means first day you get $6,000 to pay your daughter, your son, your neighbor kid who's been helping you out with the lawn or fixing things, maybe the church that's getting you some meals, whatever, your niece, your nephew, your best friend that's helping you out. We all know how important cash is. And with 50% being paid in cash, that's a very strong benefit. So, and why Fast 50? This is a stat that, okay, so because family does matter. If you've been in this industry long enough, we know that 80% of claims start at home, and 3 out of 4 of those claims, it's exclusively family and friends that are doing the care. Matter of fact, again, you've seen from 2015 to 2020, the number of unpaid family givers is now up to 53 million, you know, up from 43 million. So, and that's ever growing as we're aging as a population. I've often said we're simply running out of places to put people and able-bodied people to take care of people as this tidal wave of care comes. So if you are unable, because what happens if you don't have insurance? You rely on family and friends. So if you're unable to pay family and friends, I would argue that your claims are going to be not very fun, okay? So 78% of adults living in the community or need long-term care have been depending on a family and friends as their only source of help. That's just straight facts, right? 75% of the time, it's going to be family and friends. So why not have a plan that's going to be able to pay them, okay? And then this is true, by the way, of long-term care. You know, Mutual Omaha has a 25% cash benefit, or you can get there with Thrivent. You also have a benefit, you know, with NGL. So you really need to have that cash ability, not NGL, Thrivent. Okay, so it's an animated slide, bear with me. Okay, so again, the Power Fast 50, what I just mentioned here, paying the family and friends is very, very important. We have an example of the cash thing in the brochure, example of Claim of Anthony. You'll get a brochure eventually here. I know they're going to send some materials out after this. You're going to copy this PowerPoint. But again, next week will be more in depth. Call our marketing office if you want all the marketing goodies that we put together in this plan. Okay. Lastly, here, as far as the benefits, hospital indemnity, you know, like a lot of the carriers are doing now, they add this hospital indemnity rider in there, or cancer rider, or, you know, give or take it. I don't know. If you talk to a client that's got a Medicare Advantage plan, you might want to, it's pretty competitive. You know, I don't want to talk about it because I don't really complicate the sale with this. Okay. So let me go into phase 2 here. What do we got? Well, it's about a half hour in. Okay. We got about 5-10 more minutes here. I just want to get your interest here. Pique your interest, if you will, because this policy has really piqued mine. You know, I had written short-term care plans. I had declines that I would then pivot to short-term care. I would sell them a short-term care and I'd piggyback a home health care on with it. I write a GTL recovery cash. or an Aetna recovery care, and then I piggyback it with a home health care plan. Okay. So I was already doing that. My mindset was, yeah, well, this is great for decline cases, which I have alluded to. It does allow us to insure more. But when I've gotten looking at this, I've really kind of got under the hood, if you will. I am seeing opportunities for this plan. So it's time to abandon the notion that short-term care is only an alternative solution for decline long-term care cases. It's not. It's time to reprogram our LTCI brains into accepting the fact that short-term care can be a better option than long-term care in many cases. Yes, I did say that. Short-term care can outperform for your bang for your buck, your premium dollars come claim time. You are better suited in a short-term care plan in many, many situations. So let me I went through one just to kind of try to illustrate this. Think about it this way. A long-term care plan, if I wrote $4,000 a month benefit 3-year plan, you know how many people write that benefit because it's gotten too expensive to write a $7,000, $8,000, $9,000 a month long-term care benefit? So I see a lot of people saying, well, you have extra income. So you see a $4,000 a month benefit for a 3-year period versus if I ramp it up to the whole $12,000 a month over 1 year, it's $144. So I'd ask you a question. If you were on claim or just forget claim, if someone was going to give you money, would you rather get $144,000 over the course of 1 year? Would you rather get $48,000 over the course of 3 years? I can tell you that almost nobody is going to say, yeah, I'd rather, especially if you're on claim, who knows, you die. I mean, or your claim ends, or of course, there's no lottery winner out there that says, I will take my money over the next 40 years in annuity versus I want it all up front. If there was no, like, the lottery will give you some type of there's a give up for taking the cash option up front. Well, there's not here. So you'd have to be crazy not to say, yeah, I will take all of my benefit up front if I can, versus being bled over a 3-year period, right? We're trying to recoup the premium dollars that we spent. So naturally, you would want to take a benefit over 1 year versus 3 years. Let me go further on this. This is a slide that you have seen me do before if you've been on any of my webinars. I'm a big believer of this. This is called my shorter, fatter. Let me escape real quick. I'm going to go back into this. You see this premium here? I've taught people for years. You don't write a 5-year benefit, $270,000 pot of money. There's different ways of designing. If you'll notice this slide here, 270, 270. Okay, here's a 5-year benefit at 5% compound, 100%. Premium for a 6-year-old couple, $11,488. Let me show that real quick. Let me bring this over, right? So there's a premium for that, $11,488. I would tell people you've got to be crazy to be selling a 5-year benefit and 5% compound. We don't do that anymore. With how long-term care plans are priced, and it's not all the carriers do it, we don't sell that anymore. Well, then it got to the point where I told people, look, you need to sell 3% and go to a 3-year plan and increase it to $7,500 instead of $4,500. Shorter, fatter. Look how much money it saved them. And then when they change the rates again, this is actually Mutual Omaha, but all the carriers did this. Now I'm telling people just go ahead and go with $10,000 at 1%. Same $270,000 pot of money. So look what I did here on this. So let me change this quick to a $10,000 a month benefit. So there's your $11,488. It changes to a $10,000 a month benefit. Still pot of money at $270. I'm going to ramp this down to 1%. I don't care if it's partnership. It's still looking at 50. That should bring me to $58.25. You see that? All right, $58.25. So which plan design is better? I've told agents, why would you charge someone twice as much and have them bled over a 5-year period? You want to shorten and fatten this up so people can get their premium dollars back as quick as they can. I have preached this for 10 years. So now all we're doing, go back into presentation mode because Lynn set this up in such a way that it's going to animate. All right. So now think about this. So all we're doing here is taking shorter and fatter one step further, right? So now I'm going to condense this down into 1 year, and I'm going to do a $12,000 benefit. So, and again, I look at the benefits now and over the next 20 years, come claim time, average age is age 85 or 80 here. So, in all these examples up here, at the 20th year, you'll notice they're all right around $12,000, $13,000 payouts, 20 years. What's this one paying out in 20 years? Oh yeah, $24,000 a month. Remember, unused amounts don't stay in the account like a long-term care plan. They go in your pocket. It's full and cash and benefit. So is better to be paid $12,000 a month for 1 year, keep the extra money. Let's just say the bill was $6,000. I can keep the extra $6,000, and then I could have if the claim does go on, I've got the ability to have $6,000 more in my pocket. I'm not taking away anything from someone by paying him twice as much over 1 year. And again, I would argue it's a much better deal for the client, way better. Look at the premium in this, 30, and then by the policy maximum here is 288. 3,900 versus 5,800. Now I know that people are selling limited benefits now. We're not selling 5-year, 8-year plans. You can't even sell unlimited benefits. I guess you can with NGL. You know, how many unlimited are you selling? How many 10,000 a month with a $500,000 pot of money? You know, premium's 25 grand on that. We're not selling that anymore. I do quotes all day long. I've got agents calling here asking me for a quote for this, that, all over the country. Maybe it's not much on the Eastern Seaboard, but they're asking me for $4,000 a month benefit, maybe a 3-year plan, you know, maybe 3% compound, trying to keep those premiums under 5 grand. Look at this, how much cheaper this is. So this just goes down the same path I was on. That's even a better design. So if I have someone who I know is willing to spend 3 or 4 grand on premium, why would I set them up in a long-term care plan that's going to take them that much longer to pay out? So if you know people that are kind of strapped for money, who isn't? Who has extra money for premiums? Normally my clients don't just give me a checkbook and say, write up whatever. Okay, if I'm trying to be smart with the limited resources I have, sometimes it's gonna be better to look at a short-term care plan than it is a long, okay? Not always. There's gonna be situations for long-term care is never going away. I'm just trying to point some things out here, all right? So I'm gonna give you some claim examples here. Now here, let me go out of my software again so I can show you what I'm talking about. So traditional long-term care, we're gonna do a $4,000 a month benefit, you know, over 3-year period. So you got a $144,000 pot of money. So real quick here, let me just, and on the OmniFlex, I'm gonna do I'm limited to 1 year, but I'm gonna max it at 12,000. So 1 year benefit, 144,000. So quickly here, I got a couple slides left here, folks, but look at my roll, it's exciting stuff. All right, so I'm gonna go to a 65-year-old woman here, single, female. Okay, and I'm gonna go to 4,000, I'm gonna go to 144. Again, I like to do this just so you know I'm not playing with the numbers here. Okay, we're gonna take the inflation out of this. All right, that premium there, home health care waiver premium. Okay, 2716, you can see that? So that's where I'm getting this. So this is again, a 65-year-old woman, single. You know, we see this a lot. You sell them a 4,000 a month, 3-year plan, right? It's still 27, that's a stout premium still for folks, over $200 a month, okay? We're not gonna talk inflation right now to keep things simple. All right, so that's where I get to 2716. Now real quickly, I'm just gonna go to OmniFlex to show you how quick it is to do a claim, or to do a, this is what OmniFlex will look like. Again, there's more in the in-depth product here. We're just wrapping up here, folks. I'm almost at the big finish here. So this is the OmniFlex. So I'm gonna do a 65-year-old. Let me do a quote here. Let's see, Missouri would be, how about that for St. Louis? Yeah. Okay, female. See, if you were born 1958, I think she's 65. Okay. So we'll go to OmniFlex here. So here, no spouse. So here I'm gonna do a $400 a day benefit, 1-year plan, 90-day limb. I'm gonna go ahead and add the home health care benefit. I'm gonna max that out, all the way out, 1-year plan. I'll go 0 day there. Remember, I went home health care waiver on the long-term care to be fair. What's my annual premium? $21.63. Okay. So if you see the $21.63 here, again, this is for the 60 female. It says as long as we're in here, I might as well show you what the proposal kind of looks like. So this again quotes a 65-year-old, female. Again, lays out the benefits for you. Talks about ×2 maximum, $400 a day. All right. So that's where I'm getting the $21.63 versus $2,700. Now remember, a lot of your clients are going to get this $300 back. So I know this isn't completely fair, but I'm going with it because I'm showing the short-term care plan. $300 less, $1,863 versus $2,700. This is a 65-year-old single female. Remember, 144 each. The only difference is I'm getting $12,000 a month versus being bled over 3 years at $4,000 a month. I think we all can agree what's better, right? It doesn't take much to figure out that 12,000 a month is going to be stronger. All right. So what happens come claim time? Go back in the presentation. So come claim time, I'm going to give you 3 examples quick. This first one's a stroke. She had a stroke a couple years later. Now, she was in a facility for 15 months and died. All right. So because it's a 90-day, I had a 90-day for both plans. The first, you had to wait after elimination period. Okay, so this person was on claim for 15 months. Had they had the OmniFlex, they would have been paid $144,000. Had they had traditional long-term care, they would have had $48,000. Now, had they come home after this 15 months, okay, she recovered, she didn't die, she came home. Well, she still, then her benefits would go up to $144,000 with OmniFlex. With traditional long-term care, she'd only have access to $96,000. Okay, so she's already gotten another $96,000 that she didn't get over here. And the ability to get paid again. Remember, the total here is $144,000. The total could potentially be $288,000. And look at the benefit, or the premium, $1,800 versus $2,700. I'd have to be hard pressed to say if I have a single female at 65 years old, if she doesn't have that much money to spend, I'm not convinced that the traditional long-term care is the way to go here. And again, I've been a pure long-term carist for 25 years. It took me 6 months of doing comparisons and breakdowns here. It's really, really opened my eyes. I'm hoping it does for you guys too. Let me give you an example. Hip fracture. A little different than a hip replacement, right? This is someone fell on the ice, broke their hip. 6-month home health care claim where a daughter or a family member has been providing all the care. Very common scenario, right? Maybe daughter has to take some time off work, get mom back. So if she has an OmniFlex and she uses the Fast 50, which is 50%, remember we did a $12,000 a month benefit versus a $4,000 a month benefit. Okay, so in this scenario, they're both utilizing the first day cash. Remember, we put a home health care waiver in the long-term care. The OmniFlex has the built into it. You can get 50% of your money first day cash. So on a 6-month claim that daughters now came over to help out, mom, OmniFlex would have paid her $27,000. Traditional long-term care would have only paid $6,000 over that 6-month period. So again, 4 times the payout here. Very real scenario, okay? They both had the 0, and there again, when she recovers from that fractured hip, her home care benefit goes back to $108,000. Traditional, of course, just backs out of the one-time use pool. So it's reusable, both facility and home care. Last example, and we'll wrap this up. Okay, this is a hip fracture where, again, the same fracture, but this time she recovered home health care, but she had a nurse coming in. She doesn't have a daughter, a family member that lives close. Her son lives in LA, she's in Missouri, right? We hear about these scenarios. So it has to actually be an RN. So this RN came in 3 times a week for 6 months to get her back on her feet after this bad hip fracture. How would OmniFlex pay that out? Remember, it's a full indemnity benefit. So every time that nurse comes out, we have a $300 a day or $9,000 a month. So at $300 a day, if that nurse charged $150 a visit, well, we're going to pay her the full $300 because that's how indemnity works. With traditional long-term care, remember, they're going to reimburse her for $150. That's it, reimbursement amount. So at the end of a 6-month claim here, where again, it's an RN doing it, OmniFlex would have paid out $21,000, traditional long-term care, $10,800. Okay. Again, remember the premium difference here. Much, much cheaper to get OmniFlex. Now, folks, I could do examples like this because the more I've gone into this, the more I've looked into it. If you start putting some of the long-term care benefits in a short-term care plan and you ramp up these benefits, I am not convinced that long-term care is always the right answer. Matter of fact, I'll just tell you, it's not. Now, there's many situations where long-term care is going to be better, more long-range planning. They do have the money, the ability. They're looking to protect, maybe, I don't know, they do want a $4,000 5-year benefit, $500,000 pot of money, and they want a 10. There's long-term care is never going away. But now what we do is we have a bona fide option for people who maybe can't get the long-term care, for people who maybe can't afford a long-term care. And sometimes it just ends up being a better deal than long-term care. So I want to again talk quickly about our Instant Pivot, and then I'm going to tell you that we're going to get out of here. So we have an Instant Pivot tool that I don't know if you heard much about it. I'm not going to go into it today, but more or less what this does is this just says all the plans are available out there, from True Freedom, Manhattan Life, OmniFlex, Aetna, Aetna's Recovery Care, GTL's, all the short-term and long-term care plans in the market. You type in a condition, it's this, for example, I don't know, kidney failure. All right. Boom. You see what happened there? It only gives me the plans then that will accept it versus won't. So what a great tool for us sifting through when you have some people that are sick. That's available on goldencareagent.com. Just a phenomenal tool to let you know what plans are going to take your condition and what plans aren't instantly, what state they're accepted in, so this is a great tool. It's available on goldencare.com. All right, so let's wrap this up. That's the Instant Pivot tool. Great way to kind of lead into this. If you want to learn more about this plan, I really strongly suggest, because Tom Randall is the brains behind this. He's been the weird scientist and back in the lab here for 3 years putting this together, and he's done a great job. He's hit such a home run here. Can't say enough about how hard he's worked on this, but he really is going to go in depth on this for those of you who really want to have a good product breakdown. Tuesday, June 27th, 11 a.m. He will break this thing down I just kind of blew over the highlights. I kind of wanted to explain to you why GoldenCare went down this road, why I think the industry is moving this way, what we tried to do to address it, and then some of the ramifications coming out of it, looking at it really as a real solution to maybe not just, declined long-term care cases, but for a lot of situations, just a lot of cases that come my way, I'm going to be looking at OmniFlex along with long-term care. And I hope other subsequent short-term care plans to come, but right now, this OmniFlex is kind of the cat's meow, like I said earlier, and I think it's going to really be able to help a lot of your clients. So I want to thank you guys for coming on board and watching this and spending some time with me. I know I went 45. I didn't know how long this would go, but super excited. We had a huge class today. Thank you, folks, for coming on board. Look on our website for upcoming. Remember, next week, Tuesday, 11 a.m., Tom's going to go a deep dive into here. Folks, thanks so much for coming on board. I'm so excited about this plan. You'd probably tell, but I really think we should be looking at this more and more, especially as this long-term care industry continues to change, longevity. I'm super excited about this. So give us a call, 800-842-7799, and thank you so much for attending.
OmniFlex. Put it in your portfolio today. Call GoldenCare at 800-842-7799.